Good morning. This meeting of the Investment Committee is now being recorded for record-keeping purposes. By participating in this session, you are consenting to the recording, retention, and future viewing of this meeting. This meeting is now being live-streamed. Thank you very much. Please proceed.
Great, thank you. Good morning, everyone. I am Glenn Becker, and I chair the Investment Committee of the Pennsylvania State Employees Retirement System, and I would like to call to order this September 28, 2021 meeting of the Investment Committee. Jim Nolan, may we have a roll call, please?
Yep, we'll start with you, Mr. Becker.
Here.
Senator DeSanto.
This is Chuck Erdman, designee for Senator DeSanto.
Thanks, Mr. Erdman. Chairman Feldman.
Here.
Representative Frankel. Representative Frankel. Or Mr. Acco. They will come back. Treasurer Garrity, I think I saw.
I'm here.
Full Treasurer.
Hi.
Senator Hughes.
This is Matt Lindsay on behalf of Senator Hughes.
Oh, Mr. Lindsay, thank you. Mr. Jordan.
Here.
Representative Schimmel, I see.
I'm here.
Yep. Oh. Ms. Soderberg.
Here.
Thank you. Secretary Thal is out, I think you said, Terry? Secretary Thal?
That's my understanding, Jim. Correct.
Okay, thank you. Absent. Secretary Begg?
Hi, this is Alan Flanagan sitting in on Secretary Begg's behalf.
Okay, thanks, Mr. Flanagan. And that completes the roll call.
Great. Thank you, Jim. The first order of business is the approval of the minutes of the July 27, 2021 meeting of the Investment Committee. May I have a motion, please?
So moved.
Thank you. May I have a second?
Second.
Second. Thank you. All in favor, aye?
Aye.
Opposed, no. Hearing none, motion is passed. For old business, we have no old business on the agenda today, so we'll move on to new business, and we do have several items here. We will have some CIO updates. We'll have the quarterly performance analysis by Callan for the defined benefit, defined contribution, and deferred compensation plans. We will also have pacing updates for the private market portion of the portfolio. And then we will have presentations on 3 private equity and private credit opportunities. So for this, I'd like to turn it over to our Chief Investment Officer, Jim Nolan, and the investment office team. Jim, if you will.
Thank you, Glenn. Chairman Becker. Yes, if you would kindly go, can you hear me okay? Is the audio connection working well?
Sounds good.
Okay, great. Thank you for that confirmation. Yes, if we direct you to 5A in the board docs portal, and I'd ask you to open up the first presentation there labeled Rebalancing Update, and it's also being live streamed. And if I could direct you to page 1, just as a refresher, at the last meeting, we were asked to look at potential alternative asset allocations in comparison with what had been in place in advance of the expected rate of return decision. And that was done in one specific allocation was developed by staff and the consultant. Callan, thank you for all your work on that, Callan. And that was approved at the previous board meeting in July. So that brings us to this rebalancing presentation where we put the money in the ground per the board's preferences defined in that asset allocation. And as you can see on page 1, what we were targeting was to get each asset class, equity, fixed income, Treasury inflation protected securities, also known as TIPS, as well as cash in preparation for meeting our monthly benefit payments, all closer to target. you advance to the next page, there's a summary by asset class of the before situation and the after. So before, you can see we were quite a bit off our targets, and that was because of the implementation of that new alternative asset allocation. So staff went to work in conjunction with the consultants and developed several scenarios that we analyzed and came up with an optimal one after reviewing with Mr. Becker and Terry. We came up with this scenario, and you can see in the adjustment column the actual dollars that moved, and then to the right, of course, the after scenario. You can see where we ended up after and close to where we are today. And you might ask why we didn't close those gaps tighter. Well, there's only so much you can do if you're pulling assets from one segment, that would be the return seeking or the capital preservation, and moving it to the other. So we essentially moved all we could to get us as close to the new target asset allocation as possible. And that leads me to a discussion point and a motion that we want to cover with you, which I'll do in just a minute. The next page, or page 3, yes, thank you, Kelly, or is Kelly doing the slides today? This is a recap of how these dollars were invested. As you can see, we targeted low-cost passive index funds for the equity exposure, and we redeemed from an active fixed income manager, and then the rest from the bond index fund that we have had in place for years. We rebalanced the 2 Treasury Inflation Protected Security, or TIPS, managers so that they have a similar amount each, being mindful of the fee breaks to ensure that we're getting the best fees in the structures from both of those managers. And then cash was increased just a tad. A lot of distributions are coming in from our private market portfolio this year, where Jason Berger, one of our portfolio managers, has been doing an analysis for us, monitoring that and pointing out that the distributions are coming in well ahead of contributions being called. That's making the private markets portfolio is generating a lot of liquidity here for us, eliminating the need for us to sell assets, for example, out of the public stock markets. So keep those distributions coming, private markets team. Appreciate that. The next page just recaps the managers before and after. I'll just point to the TIPS manager down below. You can see they're both around the $500 million mark, optimal from a fee perspective, and we get diversification by having 2 managers. Any questions at this point? Okay. So moving on, a recommendation that has been developed. We worked, internal staff worked with the consultant Callan and Company. In fact, the private market consultants, everybody who's involved in this. We currently have a strategy labeled, and if we go to page 6, please, the next page, thank you. At the top of the slide, you'll see the name of a fund that many of you are familiar with. Maybe some newer board members aren't as familiar, and we need to do a little bit more education around what we have in the ground and bringing the managers, or at least our staff, in and explain these strategies. I had a couple of requests from board members on this BAAM Keystone. That's short for a Blackstone investment manager separate account that they developed for us, labeled the Keystone Fund. So that strategy is designed to provide downside protection for the system and to generate reasonable rates of return. That sounds a little bit like capital preservation to us, and it is over in the return-seeking portion of the portfolio. It's housed currently in the private credit bucket. So if you look at that chart on the lower half of the slide, you'll see the private credit allocation appears to be 1% overweight. In reality, most of that exposure is this Blackstone Keystone Fund that is designed to generate mid to high single-digit returns, but provide great downside for the system, and they have in the past for us. 2018 is a notable case where they held up well when the return-seeking portion of the portfolio declined. So what our proposal is to move that strategy back into the public fixed income category under opportunistic fixed income, where it will be additive to the fixed income return. We clearly have confidence in this manager being able to outperform our benchmark, the Ag Bond Index, on a net of all fees basis. And it is a semi-liquid strategy, meaning from time to time when we need to rebalance, like we do now from the previous slide I showed, we want to draw funds from that strategy now and deploy them into the new asset allocation structure. You might ask, why haven't you done that already? Well, our rebalancing policy prohibits us from touching assets in the illiquid categories. For obvious reasons, you really can't. So by moving this Blackstone Keystone Fund back into a public market bucket, the fixed income, opportunistic fixed income, it's in with other assets that are similar in the risk return characteristics. It's in a position to generate additional value for the fixed income program. And it is now available for us to finish the rebalancing process that we started to get us up to the new target. That's the justification for why we want to move that over there. And with your support, we have a motion here to do that. Just wanted to be fully transparent and let you know that this situation existed and that we think this is the best path going forward. And that's staff and the consultant in consultation with the investment committee chair and the executive director. So with that, I'll take any questions if anybody has questions.
Yes.
Okay.
Treasurer Gary has a question.
Thank you, Mr. Chair. So Jim, basically you want to do that because if we don't, we couldn't make a partial redemption?
Yes, we're prohibited under the current rebalancing program from redeeming from assets that are outside of public market asset classes. That is correct. We could, every time we wanted to redeem from a manager, come and make a board presentation and go through that whole thing and roll call and everything just to effectuate a rebalancing. But this would move it so that it's available to staff to actually implement the investment or the rebalancing policy, which is, I believe, what the board's intention was, to just have that be done on a continual basis. The other thing, Treasurer, I wanted to mention, the strategy grew. As I said, it's done a good job for us. They've performed well and exceeded $1 billion several years ago, and we did redeem from the strategy and resized it. It was becoming a bit of a concentration risk. It charges a little higher fees than an index fund, so we're being mindful of not getting too exposed. Well, it's back over $1 billion again, and that is why we were interested in redeeming from it. And then it was brought to my attention that I could not do that during the rebalancing, so I talked with Chair Becker about that and bringing it forward here just to get keep everybody informed what we're up to here and why.
Okay. Was it moved 6 or 8 months ago?
Yes, I believe it was originally in the opportunistic fixed income bucket previously, but there wasn't a bespoke investment made or recommendation specific to that strategy being moved over. It was kind of in a batch of things that were happening, I believe, with the fixed income presentation and the liability initiative that was underway. And we just thought we should bring it to your, anytime I believe as CIO, anytime I see something that looks like it's potentially a risk to the system, I believe it's my responsibility to make you all aware of that and have a path forward or some choices. You may opt to leave things as they are, but at least I bring the risks to you and bring alternatives. And the risk I see here, Callan did a good job generating an array of alternatives for the asset allocation project last meeting. And long and short of it, you've got to be able to get the returns that their capital market assumptions are targeting to actually realize, to have a chance to hit our 7% rate of return. This strategy is not a high test private credit strategy like you're going to hear from today. Two very high performing managers that are existing managers of ours. And we're targeting mid-teens, high teens for those strategies and returns. This strategy is a downside protection 6 to 8% return type strategy, which has taken on some element of illiquidity to try to stretch for return to get it over into that side of the portfolio. But we think that the manager's sweet spot is a more liquid form, lower expected rate of return. I think they'll be, and we've had calls with them, they'll be in their comfort zone. They'll be set up to win, to succeed against the fixed income benchmarks and not being challenged to compete with these double-digit private credit strategies. And finally, I feel that I'm doing a disservice to the system by not allocating to these higher conviction private equity opportunities when we know full well we think those returns are going to be in the neighborhood of double to even triple what this strategy is designed to generate. But yet, having it in this bucket closes the door on private credit opportunities that we otherwise would see, two of which you're going to hear about today. So assuming there's concurrence to move this strategy over, we can entertain bringing in these higher return potential managers to work together towards our goal of generating 7% return.
Thank you, Jim, and thanks for that clarification and the transparency. I appreciate it.
My pleasure.
Thank you, Treasurer. And I just wanted to chime in that we're not really big fans of moving things around in the portfolio. But when we did revisited this particular holding, and it just made much more sense to move it out of the private credit bucket. And so going forward, I think it'll serve us well being in the opportunistic bucket. So that's it's not something we like to do a lot, but when we revisited it, it just seemed to make a lot of sense to make this move.
Chair Becker, it's Tom Schinger. Can I add one?
Yeah, yes, Tom. Tom, please.
Thank you, Chairman. So what I would add to the Treasurer's question is that with this moving back to fixed income, we will have to revisit the liquidity parameters that have been agreed upon with BAN. So the liquidity parameters as they're currently set up are less optimal for fixed income, and we do anticipate those changing. That is stated in this slide that there's going to be a partial redemption over time, updating of the objectives, making sure that the liquidity parameters are consistent with the place in the portfolio. So hopefully that helps address the question too.
Thank you, Tom. Any other?
Any further questions? Okay. Let's move on to the motion then. Allow me to read the motion. A motion is in order to recommend that the State Employees Retirement Board authorize SER staff to move the BAAM Keystone portfolio from the private credit asset class to the opportunistic fixed income sub-asset class in furtherance of the current rebalancing initiative. May I have a motion, please?
So moved.
Thank you. May I have a second?
I'll second it.
Thank you. We have a motion and a second. Any further discussion before going to vote? Okay. Jim, may we have a roll call vote, please?
Yes, we'll start with you, Chair Becker.
Aye. Yes.
Okay. Mr. Urban, on behalf of Senator DeSanto?
Senator DeSanto's back on again.
Hello, Senator.
Yep.
That was an aye?
Aye, yes.
Thank you. Chairman Philman?
Aye.
Representative Frankel?
Dan Octo designee, yes.
Thanks, Mr. Rocco. Treasurer Garrity?
Aye.
Senator Hughes? Or is Mr. Lindsay on behalf of Senator Hughes? My bad.
Yes.
Thank you. Representative Schimmel?
Aye.
Ms. Soderberg?
Aye.
Secretary Thal? Absent. Mr. Flanagan, on behalf of Secretary Bagg?
Aye.
Okay, Glenn, we have all ayes and
Jim,
one absence.
Excuse me, Jim, I think Mr. Jordan, did you skip
Oh,
over
yeah?
Mr. Jordan?
Oh, yes, I did. My bad. Sorry, Mr. Jordan.
Aye.
Thank you, Terry, for keeping me on track.
You're welcome.
Okay, so that's still all ayes, one absent. Mr. Becker.
Great. Thank you. So the motion carries by a unanimous vote. Thank you. Jim, back to you.
Okay, thank you. If I could direct you to, again, Section 5A of Board Docs, the Fixed Income Transition Update. Bill Trong and Jared Snyder, who you may see up here on the screen, are, I see Bill. Jared, are you present here? Just say hello to the board.
Yes. Good morning.
Okay. Jared joined us from Charles Schwab now a little over a year ago, I think, and he brought a lot of value to the organization, and he's been working on all these presentations and transactions. So any questions you have, Bill and Jared will address. But just as a background, if you reference page 1 of that material, which is labeled Fixed Income Transition Update, you'll see there's a chart there, a table in the middle of the slide showing what they're labeling as the old and the new fixed income structures. And what we were trying to do, with the prior CIO was trying to do, was set the system in a path to head down, a path to try to align the assets more with the liabilities. It's a similar structure to how banks, insurance companies. I came from the corporate pension world. We did that over at the Hershey Company. We actually implemented a full LDI strategy. But we were all these entities I just referenced are typically much higher in their funded status perspective. So case in point, we were 105% funded when we implemented that at my prior employer. Here we're not quite there yet. As Corn Ferry just covered in the previous meeting, we got a little ways to go to really make sense to embrace this type of strategy. So we put some money in the ground, and we've been slowly transitioning the assets over the last 6 months or so towards this new structure. And then the world keeps changing, surprisingly, not surprisingly, depending on your point of view. But interest rates, I'll observe, are at the lowest level that we've seen in the cycle over, call it the last 30 or 40 years. We're near lows, 1.5 on the Treasury, 10-year Treasury index, for example. And also, the Fed's been very active in purchasing bonds. We've heard about that. So the high yield and credit indices, we're seeing the premium that you get for investing in high yield, also known as junk bonds, narrowing down. The premium that you receive over the equivalent 10-year riskless, essentially riskless Treasury, that's a very important component on how your outcome of your high yield investments are going to be. And right now, that spread above Treasuries is very, very tight. So I've asked Callan, the staff, and we studied this internally, and we've reached out to Callan and talked about taking another look at this strategy. Good strategy, good idea for a well-funded plan to go into a liability relative strategy, but we might be a little bit too premature at this point, especially given the risk that we're taking buying into longer duration bonds with interest rates extremely low and credit spreads, as I mentioned, for high yield, very little compensation being earned for taking that risk on. So I talked to Callan about rerunning this analysis and taking a deeper dive in it and coming back to you in December with what we find out. And we'd like to just put this on hold for the time being to transition. And what I mean by that, on a monthly basis, a fraction of all these portfolios are being liquidated, as you can see here, and other bonds are being bought. And it's incurring transaction costs, it's taking staff time, it's monitoring, it's a little bit of risk, you're taking risk for errors, whatever. We think it might make sense to take a pause on continuing this, come back to you in December, and give you an update as to how the world looks with interest rates as low as they are, with credit spreads as tight as they are, the potential for inflation coming back, increasing interest rates. You really don't want to be in long duration at that moment. You want to wait till those rates come back up, and then you're compensated better. In terms of the high yield, you want to wait till spreads are wider. The Fed's already talking about tapering their bond purchase program. If that happens, you could see spreads starting to widen out. They've been a big buyer. So we see those risks. Once again, I mentioned this the last segment. My job, I believe, is if I see risks, we see risks, the staff and the consultants, it's incumbent on us to come and bring that forward to this board, make you aware of it, give you alternatives, and then you decide if you want to stay the course, that's fine, but at least you've heard about it and we've shared some alternatives. So with that, unless there's any questions on the fixed income transition, I just wanted to notify our intention is to put it on hold and come back with a deeper dive in December on this whole risk that we're taking moving into these types of securities. Any questions on that thought process? Okay, that's great. And then further to that, not related to the fixed income transition, but specifically here, we have two searches going on at the moment as well. One is into the long duration asset class. That search, we want to put that on hold in conjunction and make sure we're heading down the right path. So you hadn't heard anything about that recently. We still are kicking the tires and looking at the strategies, but we got to make sure we're heading down the path that you're all comfortable with, and that'll come out during the December presentation by staff and Callan. And then finally, another search was underway with microcap managers. And in that particular situation, as we're looking at the managers, the opportunity sets, we want to be compensated, again, for the risk we're taking there because we're paying active fees to these managers. We've been heading in a path of reducing fees over the last number of years and made some good progress there. So we're trying to be careful about bringing strategies in that take active fees back on and start turning the fees back up in the other direction. And the research so far that we're coming up with, it's just not panning out. We're not seeing the micro-cap opportunities that even are able to exceed our low-cost Russell 1000, our large-cap U.S. equity in almost all time periods. They're not able to achieve that return. So that strategy, again, we're questioning, and we want to go back and do a deeper dive. I don't know if we'll have time at December to handle both the fixed income, rework that Callan and staff will work. If we can do it in December, we'll do that. If not, we'll come back to you in February with an update on the microcap and making sure that you're aware of the risks that are being taken and that you have alternatives. Any questions on Any of that, just kind of a heads up for the December meeting? None? Okay, Mr. Becker, that's the end of that section there.
Okay. We're
Next
going to move on to performance analysis, Jim?
Yes, please.
You want to do the?
Sure.
You're going to do the introductions, please?
Sure. Yep, we'll do. Okay, so if I could direct you to section 5B of board docs, you'll see 3 investment reports that were generated, executive summaries, by the way, for the Callan team to present. We have Tom, Bud, and Britt, the same team that has been presenting over the last year or so. And Tom, if you want to take it away with our splendid performance, appreciate it.
Sure, Jim. Good morning, everyone. And it definitely has been a period of strong returns for SIRS and in the markets in general, particularly in the United States. So if we could go to the next slide, please. I'm going to cover key slides. I know we're running behind schedule a little bit. So if we could go to the slide with the number 2 on the bottom right, which shows the market returns. Thank you. So I'll cover this slide to give context for the SIRS performance. So this has been a period of very strong returns where, if you remember back, the first quarter of 2020, that was the worst quarter from a market perspective. Was actually the worst quarter ever for the Russell 2000, for example, which is small cap stocks. We had a precipitous decline in the S&P 500. It was a very poor period of market performance. And then we've had a very strong recovery. We've had a lot of accommodation from central banks, including the Federal Reserve in the United States. And we've also seen a lot of fiscal stimulus from governments like the US government. So those have both been supportive of markets, and of course vaccines have helped in terms of the reopening, particularly in developed countries where there's more access to vaccines. So if you look at these numbers, the 1-year number for the Russell 3000, that's the broad US equity market, for the last year was a 44+% return. Small cap stocks did even better than large cap stocks. That's the Russell 2000. It was up 62% for the year. And you can see that there have been periods we did have a bear market, a brief one last year, but in general, we've been in a very strong period of returns since the global financial crisis. And you can see that in the returns out to 10 years for the US equity markets. Non-US markets have not been as strong in dollar terms. There's no question. You can see that in the longer term returns for 10 years. They have not been as strong. The last year has been close to the US markets, not as good. If you look at those 2 returns for under the global ex-US bucket, world ex-USA, that's developed non-US markets. So 33.6% return for the last year, and emerging markets 40.9%. So very strong returns. The equity story has been very different than bonds. So we have been in a very low yield environment in fixed income, and some rise in rates off the troughs that we've had over the last year. So you can see for the aggregate, that's the broad US investment grade index. It was slightly negative for the last year, 0.33% negative. And you can see how low the yield environment is. There's really no yield on T-bills. And then if you look below that, the other, what we'll call the alternatives markets, like real estate, hedge funds, private equity, they've all had relatively strong years. Real estate's been the one that's been the most challenged, and it really depends on the sector. So sectors like industrial, think of last mile warehouse fulfillment for online shopping, those have done very well. But other sectors like retail have been very challenged. So think of regional malls as the worst part of that. If you look at alternatives, it's been a very strong year. Jim mentioned the distributions. We're seeing that across many of our clients, and you see it in the SIRS returns. So this is the Cambridge Private Equity Index. This is actually only through 3/31. It's not through 6/30/21, but extremely strong returns for that index, 54.21%. So overall, the risk assets have done very well over the last year. and that plays through to performance for SERS. If we go forward, I will say in terms of forward-looking features, if you look at page 4, the one with page 4 on the bottom right, thank you. So it would be remiss if I didn't mention this, that we are living with new variants of COVID-19. We're all familiar with Delta. This chart is through August and showing the rise in cases, and we've seen rises in cases certainly off the late spring, early summer, and in deaths. So we are facing new challenges from Delta, and it does call into question how that's going to impact the economy. We have seen some slowdown in data, like use of restaurants and people traveling. There is a little bit of a reflection of Delta cautiousness from the surge of that new variant of COVID-19. So that could impact future economic recovery, but certainly we've seen a strong recovery so far this year in terms of both economic growth and recapturing some of the lost jobs of last year. And the next 2 slides, we cover inflation a couple different ways. So the Federal Reserve in the US, they prefer this index called the PCE. It's a personal consumption expenditures index. It's a little bit different than the consumer price index, but they're both showing broadly the same story. This is showing all the way back to the global financial crisis. You can see that inflation is up from what we've seen over the past decade plus, and it does depend on the index that we use or what type of consumption that a consumer is undertaking. So if we go to the next page, this shows the consumer price index. That's the one that everyone's most familiar with, I think, and that shows a 5.4% jump year over year. This is for the first half of 2020, so June to June, and PPI, that's a different index for producer prices, even higher. But the point is that we are seeing an uptick in inflation, and it does depend on what type of consumption someone's undertaking, whether it's goods or services. The one that's been the most glaring is used cars. So that's been impacted by the supply chain issues in new cars, lack of new car supply, what happened with rental car companies. So there's a number of factors driving that, but used car inflation has been at historic levels. So depending on what month you look at versus 2020, up over 40% in the most extreme scenarios. So that's the most glaring example, but there are others. Anyone who goes to grocery stores, you can see that there's certainly high inflation in some food products like meat. There's certainly a lot of inflation there. So the question then is this transitory? That's the buzzword that we hear, meaning is this going to be just a blip related to COVID, or is this going to be sustained over a number of years? That's really the debate today, is how sustained this inflation is going to be. And we don't know how the Fed is going to react to it. They're not saying that it's going to be sustained at this point, but it's clear from communications from the Fed that is something that's up for debate. So it's something we're watching closely at Callan. There are features of the SERS portfolio that directly hedge inflation. There is a small TIPS allocation. Real estate potentially serves inflation hedging purposes, and longer term equities can as well, in terms of companies raising their prices, so inflation ultimately being reflected there in companies being able to charge higher prices for their goods. But it does present risks to the portfolio, particularly in fixed income. As Jim mentioned, if we did see a continued spike in inflation, the Fed decided to raise rates on nominal fixed income, that would be punitive, so you'd see an impact on bond prices from that. So it's something that we're monitoring closely, and we'll see where it goes, but it is it's a major topic because of the spikes we've seen from 2020 to 2021. So I'm going to cover the SERS portfolio briefly, if we could go to the slide with the number 9 on the bottom right, please. So this is showing the total fund for SERS, the actual asset allocation versus the target. Keep in mind, this is the prior target. It's not the new target that was adopted at the end of July. It's the prior target. There were some small changes in terms of slight increase in equity and reduction in fixed income were the major changes there. But you can see as of 6/30, the overall asset allocation was very close to the target. The SERS staff is disciplined about reviewing the asset allocation relative to target and rebalancing within the purview that they have to do that. So you can see U.S. equity was right on its target. Non-U.S. was very close to target. Private equity, which we cannot rebalance, that was slightly over target at the time. Private credit, this reflects the BAM exposure that Jim talked about, was a little bit above target, and fixed income was right near its target. Inflation protection, right on target, and then real estate slightly below target, but the new target for real estate is 7%, so it's actually much closer. So overall, very close to target, and that's important from our perspective because it means there aren't unintended bets in the portfolio. If we go to the next slide, this is showing the portfolio in a different lens of the return-seeking components. So think of areas like public and private equity as the major components of that versus the capital preservation components of the portfolio. So areas like core fixed income and TIPS as components of that, and cash. So overall, again, it's the same story where the portfolio is close to its intended risk tolerance. And then I'm going to cover performance. If we could go to slide number 13, please, on the bottom right. I'm going to cover a couple slides here. So this is showing the last quarter. This is the quarter ended June 30th. It was a very strong quarter, so 6.43% for that quarter alone, and that was above the target. To do this attribution, we have to use the gross of fee performance. We do have the net of fee later in the book, but it was a very strong quarter for the SERS portfolio, driven by positive manager performance in a number of areas, including private credit, fixed income, international equity, and real estate. So overall, a very strong quarter. And then I'd say the 1 year period, if we go to the next slide, that's more meaningful to do attribution on. And you can see it was a very strong year, 29.49% versus a target of 26.9%. So excellent year on a absolute basis to have a return that high. When you think about a 7.0% discount rate, this is an excellent year for helping improve the funded status, and then also above the target. And you can see manager effect versus asset allocation effect. So what's driving it? It wasn't tilts in the portfolio. It was manager effect, meaning manager outperformance in the portfolio. So that was across a number of asset classes, fixed income, real estate, U.S. equity, and non-U.S. equity, as well as private credit. So there was a slight impact from the asset allocation, but it was mainly driven by positive manager performance. So overall, this was an outstanding year, and you can see the top performer on an absolute basis, which I'll highlight here, is private equity. So this has been a remarkable year for private equity. You can see for SERS, it was 71% return. And what's good to hear too is we can't speak directly for the portfolio, that's under the purview of Stepstone, but the fact that you're seeing distributions there, it's not just about unrealized gains, it's also about realized gains. Per Jim's comments, that's also important. So an excellent year there, and overall a very strong year driven by all of the return-seeking components of the portfolio. So the next slide, this is the last one I'll cover in the interest of time. So this is a peer ranking that we do, and you can see this is showing performance all the way out to 20 years. That relative to peers, this is a peer group of 10 billion plus peer funds. that the performance of SERVs is strong relative to peers. So it's really about your asset allocation, your risk profile, what your funded status is, what your liquidity needs is, but we do want to look at other public fund peers to see how the portfolio compares, and overall it's doing well, and you can see all the way out to 20 years the performance has been above the median. It's either been in the first or second quartile. So I'll stop there and see if there's any questions or comments before Bud and Britt cover the DC plans, the 401A and the 457B.
Jim, I just wanted to point out that one of the biggest frustrations when I joined SERV 6 years ago was looking at this schedule that you have up here and seeing we were below median in most, if not all, time periods. And then we've made a number of moves over the years with the support of this board, lowered fees, and the market's been very helpful too. Not that we had a crystal ball, but it's just great to see this ship slowly making turn for the better. So just wanted to point that out. Thanks.
Alan Flanagan has a question, Tom.
Okay.
Hi, Tom. Thanks for the presentation. One of the things that I wanted to point out for folks as well, too, just for consideration for folks by the board, there's a slide in the Callan presentation. I forget which slide it is, but it shows the asset allocation adjusted rankings relative to peers as well. I don't know if you're able to go to that slide, Tom.
Sure, it's 17 on the numbers on the bottom right. Yep.
Terrific. Thanks. So, you know, in my mind, this is one of the most critical things for us to take a look at as a board, because it tells us, you know, very clearly, I mean, you know, we set the asset allocation, but then staff has to live within those parameters and execute it to the best of their ability. And, you know, what this slide shows is that they're doing that remarkably well relative to peers, you know, out to the 7-year period, you know, number one in terms of the implementation of the asset allocation. So if everybody had the same asset allocation as what we did, we'd have number one performance, is what this tells me. And, you know, persistence of that, you know, over subsequent periods as well, in terms of, you know, second 5-year and 17th 3-year. So this is really, really remarkable performance by staff in terms of bringing in good managers and executing on the asset allocation efficiently and effectively. So I wanted to point that out for folks.
Thank you, Alan.
Great. Thank you, Alan.
Okay, that concludes it from my perspective, Chairman Becker, in the interest of time. So thank you.
Okay, good. Are we going to review the other two funds, or are you going to pass on that for an interest of time?
It's up to you. We're ready to do it. It's up to you.
Yeah. I would suggest that we move on, unless there's anyone on the committee or on the board that would like to hear those presentations. We could move on. Anybody want to hear the defined contribution and deferred compensation? Okay, with interest. Thank you very much, Tom. We appreciate that. And Jim, turn it back to you.
Yep. Thank you, Chairman Becker. And if anyone does have questions on the other presentations, well, everything we talk about at this board meeting, again, feel free, shoot an email. We'll set up a call. We'll go through anything you need. So thanks for trying to get us back on track in terms of time. Chairman Becker, I know we're behind. Okay, next thing we want to do, again, with this perspective of bringing risks to this board before something happens. Not that we have crystal balls, but we can see some risks that are coming at us with the help of our expert consultants. And I want to talk to you about that specifically today. If you go to the board docs section 5C and open up the Stepstone private equity and private credit pacing update, and we can follow along here. So let me just give you a little background why this is going on here at this particular meeting. the pacing charts that had been housed in the investment policy statement in the past were removed because they became stale, but they hadn't been updated in quite some time. So thank you all for your support in me. And one of my first objectives when I took over as permanent was to do a refresh on a number of areas within the investment office, and a very important one was our pacing models. So we contacted StepStone for private equity and private credit, and NEPC, who's here today as well, Matt Ritter, Mike Elio from StepStone Group. We've asked them to dust off their pacing models, and we were quite shocked at what we found. And when we went through the meetings and learned what was going on, these great returns that we just saw from the Callan Group, and in addition to Sarah sent us over $1.8 billion in assets, $1 billion from Penn State, $800 million from the PASHE contribution. All of a sudden, our planned assets were no longer $29.6 billion like they were in 2019 when the last pacing analysis was completed. Fast forward to now, and we're, as the Callan reports show, we're at $38 billion. So that significant increase in the asset base changed the pacing outlook significantly. Mike Elio is going to take you through the model that is shown here, but if I could have you flip a sneak preview to page 6. Just, again, a picture saves 1,000 words, and we got page 6, thank you, that's the one. So just to give you an idea of what we challenged StepStone and NEPC to do is we communicated the new alternative asset allocation that this board voted on, which is targeting, for example, private equity we have up on the screen, 12%. And if you look at Callan's capital market assumptions from the previous meeting, you'll see private equity is the highest returning asset class. So there isn't a chance that you're going to hit the 7% return without your full allocation to private equity. So it's very important to not get caught off guard 2, 3, 5, 8 years out and find ourselves 2, 3, 4% underweight in that asset class. There'll be no way we'll be able to hit our return. And that, of course, will circle back to this board. How are we going to make up more contributions? Nobody wants to increase taxpayer contributions, etc. So StepStone and NEPC have these sophisticated models. They know the managers we're invested in. They know the ones that we're going to look at, and are able to model out the distributions coming back and the anticipated contributions going in. And they can put that all into a machine and spit out where we're going to be in various years. I'll direct you out to 10 years out. You can see that we'll be, if we put out $800 million a year for the next 10 years, as this chart shows with those small gray boxes across the bottom, the blue bars being our current net asset value in the ground, which is coming back to us in the form of distributions. When you put those two together, we will be significantly underweight private equity, and that would mean we'd have a great deal of difficulty hitting our expected rate of return. So we asked StepStone what the best case scenario would be to advise this board, make you aware of this risk, and what solutions that you come out with. And if you advance to the next page, Mike's going to hit me for stealing all his thunder, but you can see several scenarios on this page, just to make sure everybody's page 7. The blue line is the $800 million I just referenced on the prior chart, and you can see what would happen down in the legend. You have a $1 billion line in dotted green, all the way down to a $600 million annual contribution to private equity, and the resulting percentage of the portfolio that would be in place 10 years out. And you can see we got some work to do. So we also agreed, both NEPC and StepStone, and Tom Schingler yesterday and I had a call. Tom applauded the idea that we're doing this at the September meeting and advised we should continue to do this annually and not let it get a couple years behind again, because those assets, that base asset, can go either direction, and it's important to refresh. and bring you up to speed. So right now, what we're saying, bottom line, we had a previous pacing target of 575 million in place, and we're only at 375 million at this point, money in the committed for this year. The real number we should be targeting is closer to 800 or more, as you can see from this chart. So we're going to ask Stepstone to give you an update on this, answer any of your questions, and be mindful whether or not we like private investments and the fees and everything else. We approved an asset allocation that's calling for this 12% allocation. And my job, I believe, is to let you know beforehand if we're going to fall way short of that, and there'll be nothing you can do out in those out years because there's not an index fund for private equity. You will just underperform for a couple of years until you catch up. So with that said, I'm asking Stepstone to update private equity, private credit pacing, NEPC to update the real estate pacing, and then if everybody's in agreement, we still have some high conviction, high returning opportunities that are still open to us as investors because of their previous relationships that we have, 3 of which you're going to hear about today. We're all in agreement on this pacing. I would thank you in advance for letting us go through and listen to these managers and protect this fund from getting significantly underweight to these high returning segments. And with that, Mike Elio will walk you through this pacing analysis, and we'll come back after that. Thank you.
Yeah, Mike, this is Glenn Becker, and I would ask that we're starting to fall behind on our time, so I think we could really concentrate on the highlights. And I would mention too that page 6 was not on the screen. At least it wasn't on my screen. And to me, that was kind of one of the highlights of it. So if you could walk us through that would be great. Thank you.
Yep, fair enough. I have presented to you enough in the past. You know I can be concise when needed. I will say Jim did a great job, so part of me wants to say just grab your tote bag at the door on your way out. But that said, if you go to slide 3 first. I just want to make sure, I won't go through all the words here, but just to repeat what Jim mentioned, the gray bars along the bottom are the growth expectations that we thought the plan would have the last time we ran pacing 2 years ago. Of course, we were at 29.6 then. We didn't think you'd get to 38 billion until 2029. Clearly, we're there now, right? So that 575 was based on those gray bars. The 800, which you already know about, is based on the blue bars of where you are and where you need to go on a go-forward basis. Remember, pacing is something that you need to go slow and steady wins the race. So we try not to make dramatic changes over time, but as the plan grows, and the numbers you heard from Callan were terrific, we do have to make adjustments, and we do visit this on an annual basis. I will say last year was not the year to do any changes, given the volatility that we had with COVID. You go to the next slide. I won't go through this really at all, but we are lucky that even within our own portfolio, we have learnings from history of what happened the last time we overcommitted, undercommitted, and then stopped. We have that volatility in our exposure within the private markets portfolio. So we just don't want that to happen again. So moving on to slide 6, which really is the meat of what we need to talk about today. Our current pacing model shows that we should gradually ramp up our number from 575 to 800. It will need to be at least 800 over the next couple of years to get to our target, which we have here on the screen at 12%. We will likely be coming back to you in a year or so, nudging that 800 number up a little by little. If we happen to go over slightly this year, also not an issue, given the pace of that line and the slope of that line as you see it here. So I don't have anything to add to Jim's comments other than 800 is a good number for now, 800 plus or minus, depending on the opportunity set that we have ahead of us. We have plenty of good relationships that the team has found, to Callan's point earlier, that we can re-up with. So we will feed our pipeline with the opportunities that we already have going forward. The next slide really just tells you the volatility in that 800. So either way you look at it, even if we're off by a growth rate of 1%, either way, we still need to go to that 800 number, and it's still a negative slope line. So again, 800 will get us gradually to our 12%. We can then monitor the overall size of the portfolio, and then, of course, readjust as we visit this on an annual basis. The next slide just shows the same thing. If the portfolio changes dramatically, again, either way, negative slope line, even at the 800 million. I won't go through, I'm keeping this really short for you. I won't go through slide 10 dramatically. Obviously, we need to commit to the private credit portfolio as well. Situation there is the same, from 450 to 500 million over time to gradually get us to our target. Those are both reasonable, sane numbers that keep us with consistent pacing over time to get to our targets. And then, of course, the two following slides also show that same sensitivity. So with that, I went through it incredibly quickly, but hopefully Jim's tee-up explained a lot of the issues that we're having in the portfolio. So again, these are the recommendations that your current portfolio, the market environment that we're in, would suggest for proper pacing of this portfolio. Did I miss anything, Jim?
Treasurer Garrity has a question.
Oh, okay, sorry. Go ahead.
Thank you, Mr. Chair. Yeah, my question is, you have the private equity allocation starting at 13.4, but they're really at 14.8, correct?
As of today, there are a lot of distributions coming off your portfolio. So it's all about timing of the numbers depending on what table and what chart you're looking at compared to the pacing tables that we're using here for the pacing analysis.
Okay, in all the slides we listed at 14.8 as of, I think, July 31st. Correct me if I'm wrong, Jim.
Yes, that is correct, Treasurer. We have a couple of dynamics going for us. These distributions are coming in fast, and the returns on the portfolio, as Tom covered in the previous segment, are very strong. So the asset class is growing faster than the total plan, and it has inched its way up. But Mike's correct in that we use June 30 data, and at that point, that was the exposure.
Okay, it just seems when we're saying slow and steady wins the race, going from 575 to 800 seems pretty aggressive to me with the current overweight in private equity. I mean, we're overweight, we're almost 1% over even the target and the previous pacing budgets. And are you saying you need to grow because the asset base has increased, I'm assuming?
Yes, that is the key driver. As I said, $1.8 billion came in from Sarah's group with the Penn State and the Pesci contributions. They had to get exposure, those dollars, and then the assets for the whole plan. Fortunately, as Tom showed, our returns have been pretty strong. So now we've gone from 29.6 to 38 billion. Even though private equity has been reduced in our modeling, Stepstone's analysis of distributions coming back and contributions going out are giving us the ability to look around the corner 2, 3, 4 years from now and see how you're going to be. You can't fix a private equity shortfall with one meeting and a motion. It takes a couple of years to get that allocation back up if we got behind, which can also be thought of as a couple of years of underperformance, especially if you had a strong period of returns. So that's what they're trying to do, is just keep us. We pick the target. This board votes on the target. Stepstone's job, NEPC's job, is to show you the path to get to that target throughout the whole period.
How would our pacing be affected if there was a downturn in markets that could take a while to recover?
Well, as Mike said, we're going to be doing an annual update. Mike, you might want to opine on this a little bit first.
Yeah, I was going to say, this isn't something that we just do once and close our eyes for 10 years, because clearly if we did that in 2019, we would be under for 10 years straight. But I think if you go to slide 8, this is a slide that shows how the sensitivity and pacing will be impacted by the growth of the overall assets under management within this portfolio. So as you can see, yes, that 13.5, remember that was the end of 2021 number. We're not there yet, but of course we're seeing the pattern of what's going on with your distributions. You'll be down to that number by the end of the year and continue to decline. Even if the portfolio drops by an extra 2% per year, we will still need to make these $800 million commitments to at least maintain the target of 12%, and it will still decline below that over time. But we will, again, to Jim's point, revisit this every year so that we can tweak based on what's going on in the overall portfolio. Remember, we are the fundamental issue with private markets. It's not like we have success and we can maintain that high level bar of NAV. What happens is with success come distributions. Those distributions come back into the plan as cash and we need to redeploy. The trick is to make sure you redeploy it in a consistent fashion so that you don't over deploy as we did historically back during the GFC time period.
Does that answer the question, Treasurer?
It does. Thank you, Mike. I just have a hard time reconciling the pacing with the fact that we're over-allocated, even exceeding our policy range when public markets are hovering at an all-time high. So it seems, I'm okay with the others. This just seems a bit aggressive to me. And I feel like
Could I just mention something? I think I view it as kind of a glide path, as kind of about where you want to be, and taking into account the distributions, the money we're getting back. So it's just over a longer period of time, we want to maintain our target, and this is kind of the glide path to get us there. And we will revisit it every year, and to make sure that we stay on the glide path.
Yeah, Mr. Chair, that's exactly the concept. I like to use the bathtub analogy. If you just pull the drain in the bathtub and don't keep adding water, you will fluctuate your water level over time. We need to keep consistent commitments as the distributions come down. And even at an 800 number, the level in the bathtub will still continue to come down.
Thank you.
Yep, that was a good analogy, Mike, and good point, Chairman Becker. Thank you. And I just want to reiterate earlier in the meeting, I did mention Jason Berger has been monitoring the situation with private equity, and I'll continue to point out our distributions are far exceeding our contributions. We like that, but eventually, Treasurer, if distributions keep exceeding contributions, it's only a matter of time till that percentage of assets that private equity represents falls off. And what you don't want to have happen is that unexpectedly in the middle of a strong market, 2, 3, 5 years out. And that's what Stepstone's modeling and expertise can prevent that risk from affecting, sirs. Any other questions for Mike on private equity or private credit? And just as a recap, I know there's a lot talked about there. The previous pacing from 2019 was $575 million for private equity, and Stepstone's recommending that we work towards an $800 million number for the foreseeable future to be updated annually. And for private credit, the previous target was from 2019, $300 million, and they're recommending targeting $490 million for the foreseeable future, again with annual updates. And while I'm on the topic, before we call Matt Ritter up from NEPC, I might as well share that factoid with you right now because it's relevant. The previous real estate pacing was from 2019 with the lower asset base was targeting 150 million a year. With the new asset base and our new 7% allocation that we approved at the last meeting, NEPC is recommending 210 million. And I will ask Matt Ritter if he can join the call with the permission of Mr. Becker.
Sure. Please.
Okay. That would be 5C of board docs. You'll see a presentation for NEPC. And Matt Ritter, thank you for being available via Teams. Take her away, Matt.
Yes. Thank you, Jim. Well, as Jim mentioned, my name is Matt Ritter. Nice to see you all. For those of you I haven't met, I'm a senior consultant here at NEPC covering real estate. And today I'll be presenting the real estate pacing plan. I'm just going to hit a couple of slides as the highlights, just in the interest of time, but of course happy to take any questions. So if we start on slide 2, you can see as has been discussed earlier today, SERS has a current target allocation to real estate of 7%. Right now, you're right around 6.9%, and this number, some of you may notice, is slightly different from what was in the Callan report earlier. That's simply a difference in the end date we were using from when we ran this plan, but it's roughly around 7%, so pretty close to the target in terms of your current asset value in real estate. But when we factor in commitments that have been made but not yet called, the total potential exposure, meaning if those commitments are called down, is closer to about 8.5%. Now, I'll take just a brief pause here. There's been a lot of talk about the growth in the overall portfolio, which obviously is great. That is a change that impacts the pacing model, but there's also been some changes in terms of the target allocation to real estate. So when NEPC started working with SERS, the target allocation was 12%, and from 2017 to 2019, we were working towards that 12% target. And then in late 2019, it was reduced from 12 to 8, and then, as you all know, this summer reduced further to 7%. So again, just wanted to give that background for some context. As you can see in the table on this slide, there are also some sub-strategy target allocations within real estate. So roughly 35% to core and non-core real estate, core and core plus real estate, 55% to non-core real estate or value-add and opportunistic strategies, and 10% to REITs. So if we skip ahead to slide 4, I'll get into the actual pacing plan. The primary objective of the plan, there's really 3 objectives. One is to remain near that 7% target allocation. 2 is to maintain those sub-strategy targets that I just highlighted. And 3, similar to in the private equity plan, it's achieve vintage year diversification. In other words, make steady annual commitments to avoid having very big years with very big commitments and years with no or very little commitments. So those are the 3 primary objectives, the 3 things that we try to solve for when we implement these pacing models. Now, before I move forward, I want to just make it clear that overall, we are confident that the portfolio is in good shape today. There are no immediate or drastic changes needed. However, given the recent changes to the target allocation, there is some recalibration that may be necessary. And the following slide will outline some of these specific recommendations. Before I talk through those, I'll just sort of reiterate something that Jim and Stepstone have said, which is that this is a plan that we will revisit on an annual basis. And in the meantime, NEPC will continue to work with the SERS Investment Office to implement the plan and identify potential managers to implement the plan with. So now on slide 5, the actual recommendations for 2021, we are recommending SERS commit $75 million to non-core real estate. That's value-add or opportunistic strategies. Given that it's already September and there's only one more board meeting this year, we've allowed some flexibility here to say that some or all of this allocation for 2021 may be deferred to early 2022. So that's $75 million for this year. And then looking forward to 2022, and $150 million is the recommendation for next year's commitments. And then in addition to that will be any amount that's deferred from this year. We are also recommending beginning next year that CSRS begin receiving dividends rather than reinvesting them, receiving dividends from the core, core plus, and REIT strategies. These are all strategies that are evergreen structures. They're open-ended, and they generate income. You can either reinvest that income back into the strategies or receive it as a dividend. We are recommending that you start taking those dividends really for the purposes of maintaining those sub-strategy allocations. So by reinvesting, you're just growing that piece of the pie even bigger. And we really need to maintain that target 35% to core and core plus. Going forward, we will follow a similar course, so making regular annual commitments, as I said, to value-add and opportunistic strategies. We will continue to monitor those sub-strategy allocations, determining dividend reinvestment policies, potentially making recommendations for partial redemptions, again, simply for rebalancing purposes. And of course, as I said, we will revisit and update this plan on an annual basis. Now, the slides that follow beyond slide 5 here have a lot more detailed outputs from the pacing model, which in the interest of time, I won't present in detail, but again, happy to take any questions there. I guess in conclusion, I'll just say, again, we believe the portfolio is in very good shape today, and we'll continue to work with the CSRS Investment Office to monitor the existing portfolio and identify potential new investments for the plan.
Any questions for Matt? Okay. All right. Thank you, Matt. Very, very helpful.
Thank you.
Good. And Jim, I'll turn it back to you for the next segment.
Okay. Thanks, Mr. Becker. Okay, if I can direct you to section 5D, as in David, in board docs. To the segment labeled Private Equity and Private Credit Opportunities. Present here from the staff working diligently on all these relationships, maintaining relationships with high conviction managers to get access to oversubscribed funds. I'd like to introduce Ryan Morse, who is, if we can see Ryan, there he is. So Ryan has been with CSRS for over 3 years now and has built up an incredible amount of momentum for us in this private portfolio, both private equity, private credit, and recently delving into real estate as well. In particular, he's brought one of our existing managers back to us today to talk about investments and their strategies. So thank you, Ryan, for participating here. And any questions you have, Ryan will be available to answer. But if I could ask the board to open up the presentation in board docs in 5D labeled CSRS Private Equity Clear Lake Partners 3 Final. There's a number of documents in there, so that's why the easy way to find it is CSRS Private Equity Partners, I'm sorry, I said 3-7, with the word revised after it. Should be the third document down, I believe. And that was revised. I'm happy to report Clear Lake has agreed to participate with the full transparency that we've asked for by this board. Prior to this material had one box unchecked, but they did a deeper dive and are very interested in partnering with us and came forward with that. So both the private equity and private credit presentations you're going to hear from Jose Feliciano from Clear Lake. That's why they're revised. No other changes to the presentation other than that. Great news that every transparency box is checked. But if you can go in the board docs material to the board members and look at page 1, I just want to point out the return stream that Clear Lake has generated on a net IRR basis over their previous funds, all 6 of them average out to over 29%. That's incredible net investment rate of return, and it ranks in the first and second quartile most their funds on both the multiple of money as well as the IRR. Okay, with that said, they also, I don't think that chart's showing on the live stream, I apologize, but I will direct you to the net loss ratio column. That also very attractive, low single-digit loss ratios. This firm also happens to be, it's Hispanic Heritage Month, it happens to be a minority firm. We didn't plan it this way to land a Hispanic firm in Hispanic Heritage Month, but we'll take it. And they have offered us competitive fees. And I want to make a point on the competitive fee. All the fees in private equity and private credit, and real estate for that matter, that are incurred, we basically give the managers this money to go out and do the work. Before they earn any profit sharing, also known as carried interest, all those management fees and the expenses to get all these investments done for us, all of that gets rebated back to the limited partner ourselves. Then they have to achieve their 8% return. There's a preferred return with this fund of 8% before they get 1 penny of carry. So I just want to make that known to you. You see our annual report out on the website. All it shows is the carried interest that the managers received. It doesn't show the carried interest or profit sharing that SIRS received, which is an 80-20 split, so it's a much larger number. So all those fees come back. We get the majority of the profit sharing. They do all the work. X what Ryan did to diligence and strategy and bring it to us. And with that, I want to ask Jose Feliciano if he could join the call here and take us through the private equity opportunity.
Great. Thank you, Jim, and good morning, or actually I think it's just turned into afternoon in the East Coast. So very pleased to be here with the committee, Mr. Chairman and the other members of the committee. I appreciate, and the staff, I appreciate this opportunity to once again present to you on behalf of Clear Lake. My name is Jose Feliciano. I'm one of the founders and managing partner of the firm. What I thought I would do today is walk you through kind of the key elements of the firm strategy. We'll get a little into performance of the past funds, many of which SIRS has been very supportive of, which we appreciate. And then obviously would love to entertain any questions that the committee may have. I understand that the committee may have our presentation, our longer presentation version of the presentation, and I'll refer to some pages as we go along, but I'll try to be as descriptive as possible in case you don't have that presentation in front of you. So first, let me start on page 4 if you're following with the presentation. The firm was started in 2006. I think a few key elements of the firm, or in a quick overview, we have roughly $40-something billion of assets under management. Most of those concentrated on the 2 strategies that we're going to talk about today. We do have a affiliate that manages credit, senior credit, called White Star. But we won't focus on that in this presentation. The elements of the strategy that have been very consistent since the beginning of the strategy and remain today extremely important to us are sector focus. We basically spend a lot of time on a few sectors. I'll talk a little bit more about that. And within those sectors, we think that we're industry experts and we have been able to deliver outperformance. It's also very important for our strategy to have the flexibility to invest in using different entry points is how we think about it, but kind of integrating the best of private equity, special situations, even credit, allows us to be more consistent and invest across an economic and credit cycle. Incredibly important, particularly for what in situations like what we saw last year, given the pandemic related dislocation in the financial markets. We'll touch on the track record. We're very proud of the track record that we have been able to deliver to our LPs over the past 15 plus years. But we'll kind of unpack that and talk about kind of a few funds. Again, a number of those are already in the SIRS portfolio. And then I'll touch on the team and an important element of our strategy. The team is almost 100 people plus about 30-something operating executives that help us execute our strategy. That's extremely important. This business obviously is all about people. I should point out that we have a very diverse team. It's not only diversity at the top. I'm very pleased to be presenting here in Hispanic Heritage Month, by the way. And then I'll talk a little more about how we do it, which OPS, this framework that we use to invest, is extremely important to us. It's just basically a set of best practices, a set of lessons learned that do integrate many areas of kind of how to improve the business, including ESG-related areas. And this allows us to be more consistent in terms of how we provide value or how we create value in the portfolio. So anyway, that's kind of a very quick overview of the firm. If we go to the next page, I'll talk about the kind of the key pillars on page 5, the key pillars of the strategy, and this applies to everything that we do today. So first of all, that sector approach that I mentioned. We spend a lot of time in technology, in the technology industry, technology sector, and industrial sector, a little bit of consumer. We actually are, kind of very focused on the consumer space in a few areas, primarily food-related investments. But in technology and industrials, which account for 85% plus probably of our invested capital, we get very deep into those sectors, understand the ecosystem, understand, kind of the management teams, really try to understand the big picture in that sector, and then we basically pursue themes within those sectors or subsectors that we think are attractive. We do that across the economic and credit cycle. One of the important things that you'll find out about our strategy is that we have an all-weather strategy, meaning that we can invest in good times and bad times. That means that sometimes you'll see us do what I would call a traditional plain vanilla buyout, let's say. In other situations, you'll see us do more complicated deals like carve-outs, turnarounds, and at the appropriate time in the market, we even had distressed capabilities that we can bring to bear. All of those were actually relevant in the past 18 months as we have seen kind of a very compressed mini cycle triggered by the pandemic. In addition to that, we paired those two elements of our strategy, basically sector approach, flexible entry point, ability to invest across an economic and credit cycle with valuation discipline, right? And we're trying to buy these businesses at a good value, but most importantly, once we buy this business, we're trying to make them bigger and better, and we do that through the aforementioned OPS framework. OPS stands for Operations, People, Strategy. We try to find basically areas or elements of businesses in operations, people, and or strategy that we can make better, and we identify those 2, 3, 4, 5 things that really matter in that investment, and then we attack that and we prosecute that vehemently, particularly at the beginning of an investment. When you step back, what that means is that kind of in the sectors that we know well, we have been able to invest consistently across that economic and credit cycle, so the all-weather component. We find good value because we always try to find good angles, good interesting opportunities that perhaps others have overlooked. But most importantly, then we work with the company, we work with the management team to make these companies larger. Both through organic growth and M&A related growth, and we also try to make them better companies, more strategic in their ecosystem. If we do that well, the end result is that we get the benefit of two things. We get larger revenue base, larger EBITDA, profit margins, etc., and also a better multiple on the way out. And we create that kind of double upside that has allowed us to generate good returns, top quartile, top decile returns with very low loss ratios, as Jim mentioned before. For those of you, then following in the presentation, if you look at kind of page 6, that's just a quick illustration of kind of how we invest and how our entry points in the investment cycle may differ a little bit, i.e., in times of distress or dislocation, we may do more special situations driven transactions. In times of kind of a better economy, we may be more focused on plain vanilla buyouts or structure equity. But the important thing is same sectors, same size companies, same idea about how to add value, just a different entry point to create a better valuation, better attach point, better creation value in these investments. If you look at page 7, you'll see kind of different types of transactions. Many of our investments are, like I mentioned, kind of plain vanilla, control-oriented buyouts. Many of them have a transformative M&A component, meaning the buy and build, where you buy the platform and then you pursue add-on acquisitions that kind of add a lot of value, hopefully create a lot of synergies, but also make the business more strategic. We are also comfortable in the special situations world, more complicated deals that may involve carving out a small division out of a much bigger conglomerate, or perhaps a turnaround situation or some other investment where the company is going through some sort of transition. We oftentimes are thinking, or always thinking about, kind of protecting the downside, protecting principal. Structure equity is an element or a tool that we utilize as a result of that, particularly in our Clear Lake Opportunity Partners Fund that the committee is evaluating today. And finally, we do understand how to navigate the credit and the stress environment, particularly in the right time of the cycle when that is relevant. All of that, if you put it in a blender, if you will, results in what you see on page 8, which is through the mix of good selection of investments, good value creation at the beginning, applying the right lessons learned, the right, kind of best practices from our OPS framework, we have been able to very consistently grow revenue and EBITDA in these businesses, again, make them bigger and better very consistently. And you see that reflected here on page 8, which in year 1 or 2, which we actually think you can oftentimes make the most impact in an investment in a new portfolio company, we have been able to grow revenue, EBITDA. Here you see EBITDA, which is not the only proxy of value, but it's a significant or relevant proxy for value. We have been able to grow EBITDA anywhere between 30 and 40% in the first few years of that investment. We think that's quite remarkable, and it's one of the key elements of our strategy and what makes us different. Page 9 is just a quick illustration of the OPS framework. Here, I'm a mechanical and aerospace engineer by training, but I oftentimes joke that OPS is not rocket science. Basically, what we're doing here is applying very consistently the best practices, the lessons learned from the past 15 years and beyond, kind of prior to Clear Lake, and we try to identify in the operations, people, or strategy kind of segment of a business, where is it that we can make the most impact? Where is it that we can create the best, most interesting inflection point to allow that business to grow even faster and be a better business? And once we identify those 2, 3, 4, 5 things, we really focus on those, particularly in the first few years of an investment, and that has allowed us to very consistently generate outperformance across the portfolio. That outperformance, oftentimes results in realizations. And in page 10, we have an illustration. We have been very active, not only buying, but selling. And we have returned upwards of $10 billion of capital to our LPs over the past couple of years. This year has been a record year, actually, in terms of return on capital and realizations. We have returned over $7 billion year to date to our LPs. A little bit more on distribution of capital, page 11. Basically, this is not the objective of the funds, but it's a nice byproduct of the funds where we have been able to generate those interesting realizations fairly early in the life of a fund. So what you see here is that our typical fund, by year 3, we have already returned anywhere between half and 60, or between 40 and 60% of the capital on average in our funds. That means that obviously we can that velocity of capital means not only we can generate a good multiple, and we have oftentimes been generating top quartile, top decile multiples in our investments, but also great IRRs, right? Which is obviously beneficial to a plan like ours. So lastly, I'm going to touch on performance. Every private equity fund or firm has a good story, but I think you have to generate performance. And what you see here on page 12, we have consistently generated outperformance in our funds. On page 12, you see the Clear Lake Capital Partners family of funds and the return profile of those funds. Fund 6 is still early on, but it's a great fund that has returned already some capital back. Has gone through the J curve very quickly, but it's still early on. Fund 5, very relevant fund, 2017 vintage, 50+% net IRRs, 2.6 plus net multiple, has already reached 90% of the capital back to LPs, which is remarkable for a 2017 fund. Fund 4, 2015 fund, over 30% net IRRs, over 2.5 times net multiple, again, top quartile for its vintage. Fund 3 is a great fund, 40% plus net IRRs, has already returned about 3 times its money to net of fees to investors, and continues to do well. There's one investment left there. And Fund 2, good fund, although in comparison to the others, it looks less exciting, but it had generated, kind of high teens type of returns on a net basis and a net multiple of almost 2x. So we're very proud of the performance of the funds, and we think this performance it's replicable, although obviously past performance is not necessarily indicative of future results, but we feel good about our strategy. Page 13 then basically has a performance of the Clear Lake Opportunity Partners funds. These funds are more credit oriented. The objective of these funds is then to preserve principal, generate a consistent ideally double-digit current income or current yield profile, and then generate some or also provide some upside optionality. So what we're trying to do here is, with very good protection of principal, oftentimes using structure equity or other credit structures to protect the downside, we're trying to create a underlying, kind of low double digits return plus equity upside to get us to high teens or low 20s type of IRR. So funds are doing very well right now and performing along those lines. So we are very excited about the opportunity here. I think this fund will be more appropriate for the private credit bucket, which I think is where we're being considered here. But the funds have performed extremely well as well here. And then lastly, I want to finish just with a couple points on the team. In pages 14 and 15, you see kind of some statistics about the team. But the team has been together for a long time. Many of the folks and the senior members of the team came from some of our prior firms where my co-founder and I worked. We have a team, as you see here, that has lots of diversity on many angles, including gender, ethnicity, and socioeconomic background. We continue to build a team. We have a team and a culture that I'm very proud of in terms of kind of how we work internally, teamwork, collaboration, and always trying to get better. And I think those are being core tenets of our culture. And again, from the very beginning, we have been very focused on being good stewards of your capital, but also being kind of good members of society. So we oftentimes are giving back. We have created a foundation. We oftentimes are very supportive of many organizations out there that work to better not only society, but very specifically things like diversity, et cetera, in the financial services industry. We have been very active there. And lastly, over the past, and you see it on page 16, over the past several years, we have been very, very focused on integrating the best elements of ESG into our strategy, and we have done that, I think, quite successfully. We have an outside consultant that works very closely with us. You'll see a few announcements about Clear Lake and ESG in the next several weeks, but it's definitely something that we care about and we have tried to incorporate into our regular investing. So I'm going to conclude there. In the back of the presentation, there's some case studies. There's also some of the term sheets that have some of the highlights in terms of terms for the funds, which I think Jim already highlighted, as in some of the memos that you may have from the staff. I'm going to just mention there that we care deeply about the alignment between GP and LP. Our funds not only have some of the features that Jim mentioned in terms of preferred returns and obviously the need to return all fees back to the fund before we can share plus a preferred return before we can share in the profits. But our carried interest waterfall is actually what they call a kind of hybrid European American waterfall. So actually there are elements of the waterfall where we have to return also all the capital back before we can share in the profits. But the point is that we are very focused on that alignment between GPs and LPs, and we care deeply about that. So with that, I'm going to conclude here because I know the board is short on time. Would love to, if there are any, entertain any questions. If not, I'll just say, thank you. I appreciate your support, your consideration. We don't take anything for granted, and would love to have that support for these next two funds. But let me pause here and see if there are any questions from the committee.
Any questions for Jose? Thank you very much, Jose. An excellent presentation. Any questions, please? Okay, hearing none. I'll say thank you very much. We really appreciate it.
Thank you.
And we will move toward to the motions. We actually have two motions that we're going to cover. And allow me, I'll read the motion number one, which is for the private equity asset class. And a motion is in order to recommend that the State Employees Retirement Board commit up to $100 million to Clear Lake Capital Partners 7 LP plus investment expenses and pro rata share of partnership operating expenses consistent with executed partnership documents as a follow-on investment within the private equity asset class, subject to successful completion of contract negotiations and execution and delivery of closing documents by all parties, including required Commonwealth legal approvals within 12 months. May I have a motion, please?
So moved.
Thank you. May I have a second, please?
Second.
Thank you. We have a motion and a second. Any further discussion before going to vote? If not, may we have a roll call vote, please? Jim.
Okay, we'll do Mr. Becker. Again, there's a number of documents in 5D. The first one we're doing here is the strategy labeled Serves Private Equity Recommendation Clear Lake Capital Partners 7, final with attachments revised. So if you didn't have that open, you're wondering that's the one that we're doing here. It's not on the live stream. Apologize for that. We're going to make this better going forward. So that first private equity fund is the one that Mr. Becker just read the motion on, and I'll go through the roll call. Mr. Becker.
Aye.
Thank you. Senator DeSanto.
Aye.
Mr. Fillman. Chairman Fillman.
Aye.
Thank you. Mr. Acco, on behalf of Representative Frankel.
Aye.
Stan. Treasurer Garrity.
Yes, I'm voting no on this one, just because of our current overexposure to private equity that I mentioned earlier. Thanks.
Okay. Mr. Lindsay, on behalf of Senator Hughes.
Aye.
Thank you. I'm not going to miss Mr. Jordan this time. Mr. Jordan.
Aye.
Thanks, Greg. Representative Schimmel. Try again. Representative Schimmel. Or are any designees, Ms. Boyle or Ms. Vecchio, available? Okay, we'll mark that as absent for the time being. Ms. Soderberg.
Aye.
Thank you. Is Secretary Thal attended yet? No? Okay, absent. And Mr. Flanagan, on behalf of Secretary Begg.
Aye.
Thank you. 1, 2, 3, 4, 5, 6, 7, 8 yes, 2 absent, and 1 no. Chairman.
Okay, thank you, Jim. Thank you. Motion carries. Thank you. And the second motion is for the private credit asset class, and allow me to read the motion. The motion is in order to recommend that the State Employees Retirement Board commit up to $75 million to Clear Lake Opportunities Partners 3 LP plus investment expenses and pro rata share of partnership operating expenses consistent with executed partnership documents as a follow-on investment within the private credit asset class, subject to successful completion of contract negotiations and execution and delivery of closing documents by all parties, including required Commonwealth legal approvals within 12 months. We have a motion, please?
So moved.
Thank you. May we have a second?
Second.
We have a second. Thank you. We have a motion and a second. Any further discussion before going to vote? Hearing none. Jim, may we have a roll call vote, please?
Yes, in similar fashion, just being clear, all those documents and board docs, this is the second one that ends with the word revised. It's the CSRS Private Credit IC recommendation, Clear Lake Opportunities Partners 3. And we didn't get to introduce that. Jose covered both of them at once, but we've been in previous months with them, and that history is generating a 25% net IRR. Again, very low 2.1% loss ratio on this strategy. So it's an incredible opportunity for the system as well. So with that, Mr. Becker.
Aye.
Thank you. Senator DeSanto.
Aye.
Chairman Philman.
Aye.
Mr. Acco, on behalf of Representative Frankel.
Aye.
You. Treasurer Garrity.
Aye.
You. Mr. Lindsay, on behalf of Senator Hughes.
Aye.
Mr. Jordan.
Aye.
Representative Schimmel.
This is Jill Vecchio on behalf of Representative Schemmel. He's an aye on this one, and I apologize. He is also an aye on the previous vote.
Thank you. So the previous tally is 9 yes, 1 absent, 1 no. Chairman Becker, for the record.
Thank you.
Thanks, Ms. Vecchio. Appreciate that. Vecchio. Keep the records. Okay. Ms. Soderberg.
Aye.
Thank you. Secretary Thal, have you arrived? Not yet. Absent. And Mr. Flanagan, on behalf of Secretary Vag?
Aye.
Okay, that's all ayes and 1 absent. Mr. Becker.
Okay. Thank you, and the motion passed. Thank you, everyone. Jim, I'm going to turn it back to you. We have another presentation.
Okay. We're running a little bit behind here, so we're going to try to make this go quickly. Back to your board docs material, I'll ask you to go to section 5. Hang on a second, somebody's phone's on. Please mute your phones, everybody, please. We go to section 5E, labeled Private Credit Opportunity. So 5E in board docs, there's a number of documents there that you could open it, and I will direct you to the one labeled CSRS Private Credit Investment Committee Recommendation 6th Street Partners Fund 5. And with that, again, on page 1, this I don't believe is in the is it in the live stream session, page 1. I think Dan's flipping the slides. Thank you, Dan. I think we have a different set of material there, but for the board members in the board docs memo, there's a recap. We've been in numerous 6th Street Partners. This is a group that came out of TPG, which we were in many, many funds for them over decades. And this group has spun out on their own now, very focused in this area of private credit. And they've been doing a very good job achieving exactly what we're looking for, mid to high teen returns, as you can see on page 1 in your material and board docs. On average, over the last 4 funds, generating a 15.8% return net of all fees and expenses, which, by the way, I'll just reiterate, all those fees and expenses come back to us, and 6th Street must achieve an 8% rate of return before they get 1 penny of carry. So it's a very important aspect. Low loss ratio, again, 3%, 3.4%, and they have competitive fees and rank in the top quartiles on both multiples of money as well as IRRs. And with that, Brian Darcy had another obligation who you've spoken to the last couple of times we've had this strategy, but Asha Haggart and Josh Easterly are present, and I'll ask them to take it away and try to hit the high-level slides as you can. As you know, we're running behind, but don't cut it short on important stuff. So please take it away, Asha.
Sure, no problem. Thanks, Jim, and thank you, Ryan, for all of your hard work bringing this opportunity in front of the board. I'll actually turn it over to Josh Easterly. He is a co-president of 6th Street and I think presented actually for the Opportunities for commitment that you all gave us, so he's happy to rejoin today.
Great. Thanks so much, Asha, and thanks for the board's time. You guys have obviously been a very good partner, and hopefully we've been a good partner to you. I think you're invested in the top 4 and our TAL series of funds. To level set, I'm Josh Easterly. I'm one of the co-founding partners of 6th Street and the co-president of the firm. 6th Street has 170 or so investment professionals across 9 offices, 350 total employees, and really focused on the Opportunities Fund series is really focused on pursuing thematic, control-oriented, actively managed investments that exhibit downside across corporate asset classes and buying financial assets. It's based on themes, so we have 15 to 25 migrating themes that change. And the purpose of the platform really is we're trying to extract really 2 premiums that exist and that are hard to extract unless you have a lot of people sitting with a lot of in different geographies with a lot of industry expertise. Those two kind of what I would call premiums we're trying to extract. One is a illiquidity premium, so we're typically involved or providing capital to companies or buying financial assets that don't have a CUSIP, so they're hard to source, they're hard to manage. And the second is a complexity premium, where it takes a lot of our human capital to buy either sourcing or managing or helping to redeploy the assets to actually create the excess premium. When you look at our business over time and you look at how it's performed over time, where we're investing in the capital structure of companies, it typically approximates the risk of high yield or the leveraged loan market. We've significantly outperformed those on a net basis over time, over 10 years. We've deployed in the Opportunity Series funds, I think we've deployed about $11.1 billion of capital since 2009 across the Opportunities 1, 2, 3, and 4, over 191 transactions, very low losses, and as discussed, generating across those funds a 16% net return for investors, both I think top quartile on an IRR basis and an MOM basis. So we're really excited. If you flip to page 5, I think this is kind of the where the attribution of the returns come from. We have a very broad strategy that is, and with themes that change over time. And if you had to bucket the hunting grounds, it would be control-oriented, which is typically buying portfolios of either buying portfolios of corporate loans or buying a single corporate loan, or typically that industry or that company is going through change. Investing in corporate dislocations, which is providing new money to a company that is can't access capital in the regular way, high yield or leveraged loan market. And the third is buying financial assets or portfolios of financial assets, such as non-performing loans or reperforming loans. And given the broad expertise of the platform, the broad mandate, as you see since 2009, there hasn't been a single year where we invested the same amount of capital in the same kind of hunting ground. And so the ability that one of the big challenges with investing and the type of investing we do is when there's excess returns, it typically attracts capital and those excess returns go away or actually become negative in some cases and have negative expected returns. And if you're a hammer, everything looks like a nail. And so having the ability to change hunting grounds in any year and change geographies and having the human capital to do that, again, we have 170 investment professionals across 9 offices, really provides us the ability to generate excess returns for you all. If you flip to the next page, the hunting grounds is typically 50% corporate dislocations and half between control-oriented and asset investing. Typically in North America, where we have invested outside of North America, it's been in Europe or countries that have good creditors' rights and property rights. We're typically invested at the top of the capital structure, so there tends to be a low volatility of outcomes, which leads to principal protection and low losses. The fourth chart on this page, which I think is really something we're most proud of, is that when you look at the portfolio is a really unique portfolio. About 80% of the portfolio, there's overlap with only one other GP, so one other competitor, or there's no overlap at all. So you're not waking up with exposure that could have been, that's created, that's owned by a whole bunch of people, or that could have been created in a much cheaper way, or accessed in a much cheaper way. So we have a very unique and differentiated portfolio. On the next page, on page 7, sorry. Oh, sorry, I thought I heard something. This has been the fund performance compared to the public market equivalent of high yield and leveraged loans. So about 700 basis points of excess premium compared to high yield, and about 1,000 basis points of excess risk premium on a net basis compared to again, in the next page on page 8, this is the core elements of our investment philosophy. So it really starts with development and migration of themes. It's sourcing. Everybody on the platform just kind of thinks about sourcing and really trying to set up the business to extract that illiquidity premium and that focus on things that have downside protection, upside optionality, have the right capital to really extract that illiquidity premium. And then we have a very focused risk management and value creation process, including quarterly portfolio reviews and monthly watch list. On the next page, it starts with people. I think we have now 20 people. Sorry, your deck there. We have 20 people on the platform. I think 75% of the partners together previously had a private firm and have worked together, provides continuity around how we think and continuity about our values. The last two things I'll focus on. One is we do have a ESG framework, and the other last thing I'll focus on is that, from a DE&I perspective, we're very focused as a firm. We'll focus on attracting a diverse set of talent and quite frankly, more than just attracting, but retaining that diverse set of talent, because we think it's helpful to our investment process and providing excess return for our clients, such as you all. I'll leave it there. I think Jose mentioned this. We too are focused on being good members in our community, really giving back around kind of the core values, quite frankly, of our DE&I values and getting involved in young people's lives. So I'll leave it there. I'm happy to answer any questions. Again, I know you guys are short of time, but I really appreciate our partnership and continue to work with you all.
Jim, well, thank you, Josh and Ashraf. Very interesting presentation. Appreciate that. Any further questions before we go to motion?
I have a comment, Chairman Becker, if any of the board members, they may go first, but, okay.
Go ahead.
Yeah. First of all, I just wanted to thank, once again, Ryan Morse on our team for keeping these relationships established and making sure that we're not missing fund closings, because that can happen. So thank you for that. And I also neglected to give Mike Elio a moment to talk about the very important concept here of the portfolio fit. I did cover this strategy is right down the fairway of what we're looking for. Reasonable fees, mid-teen returns, 15% plus, low loss ratios, top quartile fund, existing manager. But Mike, if you could speak to the portfolio fit a little bit before we go to the motion on that, that would be appreciated.
Hey, Jim, it's Matt Roach. I think Mike's having some internet problems.
Oh, thanks, Matt. Matt
Yeah,
Roach,
no
from Stepstone.
So the short of it is this is a manager that we know well, that you have an existing commitment to, and fits well within the private credit portfolio. We've talked about target returns there. We've talked about where that program is in terms of its target allocation. You continue to build your private credit program and investing there. And as we just approved a commitment to the Clear Lake Opportunities Fund is important in continuing to build out that allocation. So a high conviction manager for us, one that we at Stepstone have known really since the firm was founded and done diligence on funds since inception. And fits well in the context of the program as you continue to build that towards its target allocation.
Thank you, Matt. Appreciate it. Okay, any other questions from the board? Okay, Chairman Becker.
Okay, we'll move to the motion. Allow me to read the motion. A motion is in order to recommend that the State Employees Retirement Board commit up to $50 million to 6th Street Opportunities Partners 5 LP plus investment expenses and pro rata share of partnership operating expenses consistent with executed partnership documents as a follow-on investment within the private credit asset class, subject to successful completion of contract negotiations and execution and delivery of closing documents by all parties, including required Commonwealth legal approvals within 12 months. May we have a motion, please?
So moved.
Thank you. May we have a second? We have
Second.
Thank
Second.
you. We have, thank
Who's
you.
the
We have a
second?
motion.
I didn't catch the voice of the second. Who's that?
Greg.
Oh, thanks, Greg.
Thank you.
Okay.
Thank you.
With that, we'll move to Mr. Becker.
Yeah. Aye.
Thank you. Okay, Senator DeSanto.
This is Chuck Erdman, designee for Senator DeSanto. Aye.
Thanks, Chuck. Chairman Philman.
Aye.
Mr. Rocco, on behalf of Representative Frankel.
Aye.
Thank you. Treasurer Garrity.
This is Christopher Craig. I guess Boyd was supposed to vote, but his mute button is busted. The treasurer is a no on this one.
No. Yeah. And Mr. Lindsay, on behalf of Senator Hughes.
Aye.
Did I hear the treasurer's voice come back in there just now? Did you want to comment? Maybe not. Okay. Mr. Jordan?
Aye.
Thank you. Representative Schimmel or Ms. Vecchio on behalf of Representative Schimmel?
It's Jill on behalf of Representative Schimmel. Aye.
Thank you, Jill. Ms. Soderberg? Ms. Soderberg, are you on mute? Yes.
You're on mute.
You're still on mute, Ms. Soderberg.
It's an aye.
That's an aye, just to confirm?
Mm-hmm.
Thank
Yes.
you. Thank you.
My apologies.
Nope, don't worry. Secretary Thal, has he appeared yet? No? Okay, absent, we'll mark that. And Mr. Flanagan, on behalf of Secretary Vag?
Aye.
Thank you. So we have all ayes except one no and one absent, Chairman Becker. So,
Okay, thank you. Motion passed. And thank you, everyone. Thank you, Jim and the investment office and presenters. Well done. And we'll move along here. We have no special presentations today. We're not planning to break for the executive session. Informational items are found on board docs for your review. And we'd like to move to adjourn the meeting. And before that, any additional committee or attendee comments, questions, or concerns? Hearing none, may I have a motion to adjourn, please?
So moved.
Thank you. May I have a second?
Second.
Thank you. All in favor, aye?
Aye. Aye.
Aye. Okay.
Aye.
Thank you. The meeting is adjourned. The next meeting of the investment committee is scheduled for December 7, and we are adjourned. Thank you, everyone. Now, what about the next meeting now? Our board governance and personnel?
Yes, the Board Governance and Personnel Committee meeting is scheduled to start at 1:15.
Yeah, I think that will be enough time.
Okay. Good.
Thank you.
Thank you all.
Great. Thank you, everyone.
thank you, everybody. Appreciate it.